Hey, it's Nate from Navigator Bookkeeping here with the third video in the 3 Essentials of Bookkeeping video series. So far we've talked about classifying, which is putting all of your transactions into the buckets. That's going to happen weekly in your accounting software. We talked about reconciling, which is your accuracy and security check. That's going to happen at the end of the month. And we're going to talk about the third step, which is the monthly check-in. Now, I think this is the most important in some ways. They're all important. You need all 3 steps to work together to really have the essentials going, obviously. None can really work in isolation. But I think this step is where you as a business owner are going to get the most value from bookkeeping. Now, the other 2 steps are needed for to file taxes accurately, just to have accurate numbers and data so that you have the compliance side of things needed by the IRS and by your state. This last check is not required. This is not something that you have to do, and because of that, very few businesses do it. Very few accounting firms or bookkeeping firms do this as well, but I think this is where the most value is going to come in. So what is this? What are we talking about? Well, monthly check-in is where you're actually going to go over all the financial statements and all the data that you're getting to see basically what's the financial health of your business and where you're at. So what that means is when we do a monthly check-in with a client, we're going to do it through 3 financial statements. And if you're not working with a bookkeeping firm, that's fine. You can do this on your own. You can sit down with a friend who maybe understands business or is an entrepreneur. You can sit down with anyone really who just can give you more insight. But I do think it's helpful to do it with another person. Now, if that person has some good insights into business and has done this before, that's really what you want. But just starting out, just do it with someone else or even just do it on your own. But either way, just do it. So anyways, what you're going to do is you're going to look at 3 financial statements starting out. So the first one you're going to look at is the income statement. This is oftentimes called the profit and loss. I like to call it the income statement because you can't really have a profit and a loss at the same time. It's kind of a silly name. But anyways, you're going to look over the income statement. What you're going to look for is you're going to look at all of your revenue. Hopefully your revenue is split out by how you received it, either by different products that you sell or services that you sell. But what you're going to want to do is you're going to compare that to the previous month. You can compare to the previous year even, and what you're looking for is you're looking for trends. Are we trending upward? Are we trending downward? And then the important question to ask is, what are we doing about that? How do we either replicate this if it's a good thing, or how do we stop this if it's a negative? So you want to look at that revenue first and kind of see the changes there. The next part you want to look at are your expenses. These are going to be down on the income statement as you go down. Now, once again, hopefully these are split out pretty specifically, because if it's all just in one big account, lots of times we'll have a lot of expenses in like office supplies. If you just have a lot of expenses all in there, it's going to be really hard to see what's changing. So you want to have specific accounts. You want to be able to see those changes happening. You can use a lot of softwares. Even QuickBooks will let you see the dollar amount change or the percentage change month over month. I think that's really helpful because then you can see the accounts that are changing the most. This is also going to be helpful because you're going to be able to see anything that's coming out that shouldn't be coming out of your account. If you got charged twice for rent, if you got charged twice for a subscription, if you didn't get charged for something you were supposed to get charged for, this is a great way to find that and notice those things before they become big problems if you're looking at this monthly. So you're going to look at that, look for changes. I always like comparing to the previous month, but I also like to compare to kind of what I know my baseline to be. If my office supplies are always X percentage of my revenue, and I see that changing drastically, it's going to be really easy to know if I kind of know, hey, I'm always at 15% of revenue, and then I say 35%, I know that's a problem. So it's always nice to have kind of a benchmark on those as well. And then, of course, you're going to look at the bottom. You're going to see what your profit or your loss is for the month and compare that to previously. Look at your profit margin. That just means what percentage of your revenue is basically staying in the business as profit. So look at that, see how that's changing as well. So we're going to do all that with the income statement. That's usually the favorite financial statement to look at, and it is important. But the next one we want to look at is the balance sheet. The balance sheet is going to show you historically what's happening in the business. How is your cash changing? How are your liabilities changing? How is your stake in the company, the equity, how is that changing? Once again, compare it month over month, compare it year over year. You can even compare it quarters if you want, but I like comparing kind of those shorter periods. And see a couple things. First of all, you want to see how the cash is changing. How did my accounts change month over month? Is that going up? Is it going down? If it went down, do we know why? If you have a large cash decrease, it could be because of something like a tax payment, because of a large loan payoff, because you've taken a large distribution as the owner. It could be a lot of things like that, but you want to know why that's changing. If it's just going down because you're losing money, or even if you have positive profit but you're losing cash, you got to figure out what's going on there and make sure it's not something that's going to continue happening. So look at the cash, look at how your loans are changing, look how your liabilities, your credit cards are changing, and then see how your stake in the business, your equity is changing as well. You'll be able to see the year's profit in there. You'll be able to see historical profits in there, You'll be able to see how much you've taken out from the company all on the balance sheet. Really helpful data there. Longer term data though. And the third one we're going to look at is closely tied to the balance sheet, and that's the statement of cash flows. That's going to show how your cash is changing. So when you're looking at the top of the balance sheet and you see cash and you see it change, if you're not sure why it's changing, go to the statement of cash flows and it should break out exactly why your cash is changing. Things that don't show up on the income statement or the profit and loss are going to show up on here. Things like principal payments on loans, distributions to the owner, asset purchases, asset sales, things like that. So it's really important to look at that and see all the small things that, or large things that might be happening, but may not be showing up on the income statement. If you only look at the income statement, you're not getting the full financial picture. So look at all three of those together. If you look at all three of those together, and as long as your books are up to date and accurate, you're going to get the full financial picture of your business. Now, after doing that, don't stop, but now start thinking about, okay, now we see where things are for this month. Now we want to look at this compared to our goals for the business. If you don't know what your goals are for your business, it's a good time to think about that. How much do I want to be paying myself? How much do I want to be setting aside for taxes? What is my vision for where the business is going this year? Am I expanding? Am I staying in place? Am I contracting? Am I hiring on a team? Am I changing my team? Think about all those things and think about how that data is informing those decisions. So we're taking the data, we're looking really closely at it, we're analyzing it, we're consulting with it, and then we're using that to help inform our goals, and if those goals make sense, if we need to change them, and if we need to start taking action and moves inside of the business to make sure we're meeting our goals. So that's the monthly check-in. All told, that should take you somewhere between 30 minutes and an hour, depending on the complexity of your business and the complexity of your goals. I like to be really specific with my goals. Some people not so much, and that's fine. But make sure you have goals in mind. What amount of profit do I want to be bringing in? What amount of profit do I need to be bringing in? And how does that kind of inform how much I'm paying myself, my team, taxes, things like that. So this is a good time to think about taxes as well. Think about how you're saving for taxes, how you're trying to be smart about how much tax you pay each year and being efficient in that. So you can think about all those questions as well. So that's a monthly check-in. I think it's the most valuable to do every month. In my view, you should reconcile your books and then right after that, do this monthly check-in so the data is still fresh in your mind. So do it right at kind of the beginning of the month, looking back at the previous month. If you have questions, I'd love to talk more, answer any questions you have. But that's the 3 essentials of bookkeeping. If you do those, you're going to be in a good place with your books. You're going to know the full financial picture.